Hello everyone. Today we will be learning about financing decision. We started the topic in our last lecture and that topic was financial decision, and we learned that financial decision is of three types. One is investment decision, another is financing decision, and third is dividend decision. Investment decision we have already completed. We learned that investment decision is of two types: long term investment decision and short term investment decision. In long term investment decision, there is decision taken by the business organization to invest for long term period, especially in fixed assets in huge amount. And when we talk about short term investment decision, that decision is basically related with investment for short term period, and that short term period is basically up to 1 year period, and that is why that investment is to meet the day to day requirements of business, and that is what is called working capital requirement needs. And we learned finally that whenever this investment decision is taken properly in any business organization, always the return on investment comes out to be more than the cost of investment, and that turns out to be profitable for any business organization, and that results to increase in the shareholders wealth, thereby increasing the market price of the shares in the market. So today we will be talking about the second type of financial decision, and that is financing decision. So what is financing decision? Financing decision means the quantum of funds. Quantum may also be said to be the amount of funds which has to be raised from various long term sources of finance in a business organization. Quantum of funds to be raised from various long term sources, because when we talk about short term sources, short term sources are a part of working capital management, which is not considered here. Basically, we talk about the long term sources in financing decision, and when we say long term sources, that means always the time period is for more than 1 year for which the finance is required in business. And we have already learned that long term sources can be of different types. It can be basically categorized into two parts. One is the shareholders fund, And another is the borrowers fund. So two types of main sources on the basis of ownership, you can say that the sources can be divided into two parts. And under shareholders funds comes preference shares, equity shares, and retained earnings. Whereas in borrowed funds comes debentures, loans, and other forms of debt. So when we try to understand the sources of raising finance, we put it basically into two categories and understand it as shareholders funds, that means as shares, and borrowers fund as debt. And it is said that whenever a business organization has to raise funds for long term period from various sources, it has to always have optimal mix of both shareholders fund and borrowed funds, that means equity and debt, so that so that it leads to increase in shareholders wealth. We have learned that the main objective of financial decision or financial management decision is to increase shareholders wealth. So in case of financing decision, whenever there is optimal mix of owned and borrowed funds, it is always going to provide good returns. That means value addition is going to take place, and if value addition is going to take place, that means always it will lead to increase in shareholders wealth, and the objective of financial management will be fulfilled. How this value addition will take place? Because if there is optimal mix of both debt and equity in the total capital of any business organization, it is always seen that the cost of capital is minimum, and the risk which is taken, that is also minimum. So if these two things are minimum, the cost as well as the risk, always it makes capital raised cheaper, which adds greater profit and greater returns. So in this way we see that the organization benefits. But there should always be optimal mix. How this optimal mix between owned and borrowed funds can be obtained in any organization, that has to be very properly understood, and then only the financing decision has to be taken. Whenever the company has to decide between owned funds and borrowed funds, it has to know two things very clearly and analyze it first and then take decision. The first is, if it wants to go for debt fund, debt and equity fund, I am writing here. Debt is that fund which is considered as the cheapest source. And equity is considered as the costliest. But debt financing always has greater risk, whereas equity has less risk, or you may say it has no risk. No risk or less risk. So both the forms of capital has its own advantage and disadvantage. That is why always whenever a particular source is selected for raising funds, these two aspects have to be taken into consideration: cost and risk factor. Is the company in a situation for going for debt capital? Because on one hand, debt will be cheaper, but higher is the proportion of debt, greater will be the financial risk of the business organization. Financial risk means the risk of default of payment. Why there is more risk in case of debt? Because in case of debt capital, always there is, whenever the company is going for debt capital, it has to make compulsory payments, and that payment is in the form of interest on debt, whatever amount of debt has been raised, and also the repayment of the premium amount of debt on the date of maturity. So that is something which is compulsory, whether the company is in good situation or bad situation, whether it is earning profit or it is running in losses. If the company has taken any form of debt or availed any form of debt capital, it will have to repay the capital in terms of interest and repayment of capital. That is why the risk factor is always involved. and it is also cheapest source. Why it is considered as cheapest source? This is also because of two reasons. Because whenever the interest is paid on debt, interest paid on debt is tax deductible, and that makes it cheaper. On the second hand, we see that the lender's risk is lower than borrower's risk, because the lender is always assured repayment of capital in the form of interest and in the form of principal amount. That is why always the lenders, they get lower returns, and that makes debt cheaper. Whereas when we talk about equity, equity is considered to be the costliest source of fund. Why? Because those who are the equity shareholders, they are considered as the owners of the business. They have voting rights. But equity shareholders will only get their share of return in the form of dividend after the payments have been made to the creditors, the preference shareholders, so they are the last in the list. So assurance of dividend, or dividend for which they have invested and taken the risk, that is not compulsory to be paid. If there is assured profit in the organization and the business organization is earning good profit, and after making payment to the other parties, then whatever is left, that is provided to the equity shareholders. So we see that makes equity the costliest sources of funds, because there is no assurance of dividend payouts. Dividend payout not compulsory, but we see that on the other hand, there is no risk, or less risk, you may say, in case of default of payment, because if there will be profit, then only there will be payment, otherwise there will not be any payment. So no financial risk. That is why the business organization can solely not rely on any of these sources. It has to make optimal mix of both debt and equity funds in such a way that always the cost of raising funds proves to be cheaper and the risk is under control. Then only the financing decision will be considered to be good in any business organization. So after understanding the financing decision, we will understand the factors affecting financing decisions. What are those factors on the basis of which financing decision is taken in any business organizations? So whenever we will be talking about the factors affecting financing decisions, that means decisions whether to go for decisions whether debt or equity fund should be opted for raising capital. That is what is the financing decision, and on the basis of following factors this decision is taken by any business organization. So one by one we will be understanding the 7 factors. First, on the basis of cost. Now, cost of raising funds from different sources is different. Earlier also we have learned cost of raising funds from different sources is different. But always depth is cheaper than equity in terms of cost. So keeping this in mind, the firm should raise capital. We have just now understood debt is considered as the cheapest source and equity is considered as the costliest source. So on the basis of cost, debt is always cheaper than equity. Now the second factor is risk. Risk associated in raising finance from different sources is different. Associated in raising funds from different sources is different. This also we have understood. Always debt has greater risk than equity. We have understood this, why debt is having greater risk, because higher is the amount of debt, greater will be the financial risk. And financial risk means the risk of default of payment, because in case of debt there is compulsory repayment of capital and interest amount which has to be paid as per the norms, and that is why the risk becomes higher. In case of equity, we see that there is no such risk. So this factor also has to be taken into consideration. The third factor is the flotation cost. Whenever the fund is raised from any source, there is also some flotation cost involved in raising funds. Flotation cost is the cost of raising funds from different sources. And this flotation cost, that includes expenses which is involved in raising funds, that may be in the form of stationery, commission, other documents. So these are some of the expenses which is involved, and that flotation cost adds to the overall cost of raising funds. So different sources of funds, they have different flotation cost. For example, always the flotation cost of raising funds from public deposits is cheaper than shares and debentures. Raising funds from shares and debentures. Public deposit is also one of the source through which the fund can be raised. So there can be different sources, and different flotation cost is involved in raising funds from different sources. When we compare different sources, we will find that the cost of raising funds from different sources is different. Between equity and debt, if we see, then debt has lower flotation cost than equity. And also retained earnings, this is very important. Is one such source which involves no flotation cost. Because retained earning means retaining the portion of profit which has been earned by the business organization. For that, and if the portion of profit has been retained to be reinvested in business or to be kept as reserve, there is no cost involved in raising funds. So no flotation cost is involved in raising funds from retained earning. So sometimes one more question may be put on the basis of flotation cost, which source is the cheapest? So on the basis of flotation cost, retained earning will be considered as the cheapest source of finance. But when we compare debt and equity, debt is having lower flotation cost than equity, and different sources of finance have different flotation cost. So it has to be first of all compared, and then always the organization prefers to go for that source, which has lower flotation cost, because that is going to add overall value of the cost of capital. This factor also has to be taken into consideration. Then comes the cash flow position. Now cash flow position, if the cash flow position is strong, then the business organization can go for debt financing. But if the cash flow position is weak, then it should go for equity. Because we see that debt is cheaper, but in order to pay debt, there is need to have stronger cash flow position. The business will prefer to go for debt financing and can certainly go for debt financing if it has strong cash flow position, so that it is in a position to repay the regular interest on debt which it has to pay without any failure. If its cash flow position is weak, then in spite of debt being the cheaper source than equity, it cannot take the risk of going for debt capital. So this is the condition. Then we move to level of fixed operating cost. Operating cost means the cost of running the business. So this cost also has to be taken into consideration before a company decides to go for debt financing or equity financing. If the fixed operating cost, and that cost may be in the form of regular payments which the business organization is making in the organization, salary payment, rent payment, commission, premium. These are some of the regular expenses which the organization is having. And if this fixed operating cost is high, if the fixed operating cost of the business organization is high, then it cannot further go for debt capital, because already it is having higher fixed cost of running the business. So if it will go for further debt capital, then the fixed financial cost is also going to rise, because interest on debt will have to be paid regularly. So it should avoid going for debt capital, and in that case it should go for equity rather than debt. So the relation is like this: if high is the fixed operating cost, low should be the fixed financial cost. Financial cost means debt, interest on debt. That means preference should be given for equity and vice versa.